Ken Walters, Ken Lock Mortgage, and this is the bottom line on mortgages. If it has to do with mortgages, we're going to talk about it here. And today we're talking about what actually determines how much you can borrow. What's our first question?
Income types. So, what's the difference between people who are employed or self employed, and why is it such a big deal?
The difference between employed people and self-employed people comes down to one critical factor, and that is that if you're self-employed, you determine how much you make. So that means that there's additional scrutiny when dealing with somebody who is self-employed. But let's go over the simple stuff first, which is the person who is employed. So you're employed, you have a regular job, you go to work at 9 to 5 or whatever, and you receive a paycheck. The paycheck has deductions on it, you have an employment contract, and so therefore when we want to know what your income is, we can simply ask you for a copy of your pay stub. What we typically ask for is 2 years worth of your T4s. And the reason why we use your T4 is because your T4 says everything that you've earned from your employer. And so we'll take a 2-year average. Specifically, we want to use a 2-year average of your T4 income if, for example, if you are if you get overtime. So if you get overtime, that's not going to be, we don't actually include that unless it's part of a 2-year average. So if your income's a little bit higher, because you're pulling overtime on a regular basis, then we'll use that average over 2 years. The simplest way of figuring out employed income would be that way. But let's just say you recently got a new job. You're employed, you're regularly employed, but it's a brand new job. So if it's a brand new job, then the 2-year average really doesn't have anything to do with what's going on now, because now you're under a totally new type of income. In that case, we're gonna use your pay stub. Okay, and we're going to make sure that your pay stub matches the salary that you've indicated that you're receiving, and then we're going to use a letter of employment from your employer. Okay, now we're not going to use overtime income in this case because you're at a new employer, and therefore we're only going to be able to use your salary, your base income that you can prove, which would be what we're going to see on the letter of employment and your pay stub. Okay, and in some cases, banks might even ask for a copy of your bank statement to show that pay stub is in fact the amount of money that's going into your account. So that's pretty easy. I mean, yes, that's a lot of documentation. These days, banks are always asking for extra documentation. There's a lot of fraudsters out there, and with anti-money laundering laws the way they are, or requirements the way they are, we have to make sure that we've covered all our bases. Now, that's somebody who's employed. Now, what happens when we're talking about somebody who is self-employed? Well, interestingly enough, somebody who's self-employed can also have verified income. So for example, let's say you own a corporation and that corporation pays you a T4 income. Okay, well then that's just like any other T4 income. The only difference here is that because you're the one who creates the T4, the bank is going to ask for a copy of your T1 general. That's your basic tax return. And so we'll look to see what you've actually reported to the government. Now, this is where it gets a little bit strange for most self-employed people, that they typically don't claim as much as they really earn. They claim their income, that's their T4 income, but they also have a vehicle and they write that off, or they write off a portion of the expenses within their home. They do all of these things to reduce the amount of money that they're going to have to pay the government. And thus their T4 income is going to be lower. They've got write-offs within their corporation, let's say. So we'll use a T4 for an incorporated individual, but we're also going to support it with their T1 general, showing that they actually did report that amount of money to the government. Now that just takes care of the T4. The problem is that most self-employed people, they write off a lot of stuff. So in this case, for somebody who is incorporated, has an incorporated company, we're gonna need to show proof of ownership of the company. Then we're going to get a copy of their financial statements, because we're gonna wanna see what were the write-offs that they had within their corporation. Because for the purposes of their mortgage, we're gonna wanna add back as much of that as we can. And there are some lenders that will actually allow us to do that. Okay, there are many lenders that will not allow you to do that, and therefore you are stuck with simply your reported income, the T4. Now that's not where this story ends, because there is another way for us to report your income. Okay, and that would be with a B or an alternate A lender. So this is not a prime lender. Think your big six banks, not them. Now we can go to a different lender, and in that case, we can utilize your corporate bank statements. We can use receipts from some of your customers to show what you as a business actually bring in on a regular basis, and therefore we can apply for your mortgage through those channels where we have a little more flexibility. Okay. Now the reason why you'd want to do that is because the incremental cost difference in going to a B lender, the small amount of difference in your mortgage percentage, is a far cry away from the amount of money that you would pay the government if you were reporting all of your income to the government, okay, without any write-offs. So is it beneficial to be with a B or an alternate A lender if you're self-employed? Absolutely, because why would you want to pay the government all this extra money when you can simply have a slightly higher mortgage rate? Okay. Now, there's one piece of this that I left out, and that is, what about sole proprietors? Somebody who is self-employed but not a member, but doesn't own a corporation. It's very similar, but the difference is with somebody who's self-employed in that sense is we still use your T1 General. We'll still use your tax return, but inside your tax return, there is a statement of business expenses. We go through that and we find ways that we can either add back some of the expenses that you are currently that currently show up, let's say on your credit bureau. So you have a car, but we're showing the car as a debt in your application, but it's also been a write-off within your business. So that's taxing you twice. Now there's two different ways that we can do this. We can either gross up your net income, which is the common and easiest way. But if we need some additional income and you have other expenses within your business that can legitimately be added back, then we will do that. Now, this does not mean you can't go to an A lender. You absolutely can go to an A lender. The difference is just how we calculate your income, and then we determine where you're going to go. Breakdown is this. You're employed, you go to work, you punch the clock, you get the paycheck. We're going A lending so long as your debt ratios work. We're going to go A lending all day long. Not a big deal. You're self-employed. We could still go A lending, but depending on how you calculate your income will determine whether or not we may need to go to an alternate lender. Tiny little bit of a difference in the interest rate, but big savings to you each and every year in reduced tax expenses.
Being self-employed, you can write things off to make it look like you make less than you did and you pay less taxes, but then you can go to a lender who will just put all that back in and say you made more, but then you don't pay taxes on that.
Yep. That is exactly what I'm saying. We understand that you need to report your taxes, but you have the right to reduce those expenses. But it wouldn't be fair for us to, on the one hand, reduce your expenses because of a car payment, let's say, and then also when we're trying to figure out whether or not you can afford the mortgage, charge you for the car again. We legitimately would be charging you for this car twice, right? So what we do is what's that?
How?
Well, think of it this way. I pull your credit bureau, okay? And your credit bureau says that you have a car payment, and the car payment is $500 a month, okay? And you are making, let's say, you're showing $70,000 worth of income, net income, on your tax return. But inside your tax return, we show that you have been reducing your taxes by the value of the car payment every month. So instead of, let's say you've got $500 a month going towards your car, which is $6,000 a year. So instead of making $76,000 a year, we're showing you making $70,000 a year. And then I pull your credit and I say, okay, well, Nikki makes $70,000 a year, but she also has a car payment of $500 a month.
Right.
And so now we're reducing your ability to purchase on your mortgage because of this car payment. Well, hold on a minute. We already reduced your income in your tax return to begin with. So we're now double counting that car.
Right.
Right? So we need to kind of pick and choose. Which one are we going to go with? And that's a conversation that we have with the lender. We point it out when the lender sees that, okay, no problem. Now, sometimes the lender might have a rule where they say, well, we already allowed you to gross up your income by, let's say, 15 or 20%, depending on the lender. So they could also come back and say, well, you chose to gross up her income from $55,000 up to $70,000 using our gross up policy. Like, yep, I did. Okay, well, you can't have both. Okay, no problem. So then that's what it boils down to, me deciding, okay, which way are we going to go with this? Are we going to have the argument that, hey, we had certain write-downs that really should be added back to your income, or are we just going to go with the gross up policy? In that case, I would either A, pick whichever one is going to serve us better, and so long as we qualify for the mortgage, I'm going to stop right there. But if we didn't qualify for the mortgage at this point, we need a little bit of an extra, I'm going to ask for an exception to the rule and see if I can get both the gross up or at least the gross up plus some additional funds added back in as well.
What is a sole proprietor?
Sole proprietor is when you are business for self in your personal name. A sole proprietor means you are yourself and you are not protected. You're not limited in liability. If you were to get sued, they can sue you personally. So it's just sole proprietor is just you personally running a business.
You're not separate from your business.
No, to be separate from your business, you'd have to be incorporated. That's what we call a limited liability corporation. And then in that case, your company is separate from you. Think of your company as like a baby. It's a separate individual. Like, legally speaking, your company is a separate individual. Okay? But you still run the company. Right? So it's like your offspring. It's like your economic offspring.
I always hear you talk about people's debt ratios. It sounds like there's more than one. What are debt ratios?
Okay, great question. Well, there are more than one. There are two types of debt ratios: the gross debt service ratio (GDSR) and your total debt service ratio (TDSR). For residential lending, there are two debt ratios. Okay, so let's start off with the gross debt service ratio. Your gross debt service ratio is the ratio of your income to the amount of debt that is on the property itself. We take your income, your gross monthly income, and we put that up against the monthly cost of the principal and interest on the mortgage that you're either have or are trying to get, plus the property taxes, okay, and the heat. And when we calculate the heat, we're calculating 5% of the square footage, the livable square footage of the property, amounts to your monthly heat expense, okay? Now we put that together and we offset that against your income, your gross income. And the general rule of thumb is no greater than 39%, okay? So if you're getting an insured mortgage, okay, so that'd be insured through Canada Mortgage Corporation, or Sagen, or Canada Guarantee. Those are the three major ones, the three that we have here in Canada. If you were getting your house insured, then that would be the maximum. You cannot, it's not, as a matter of fact, you have to be less than 39% of your income for your GDS ratio, okay? So that means like 38.99, all good. 39, no good. The total debt service ratio is, again, all the stuff in the gross debt service ratio plus any revolving credit that you may have. Now, revolving credit would include, let's say, a personal line of credit card, a car loan, the ATV loan that you picked up, any additional credit that is extended to you. And the way we calculate that is either the actual amount of money that you have to pay. So on a car loan, the car loan's $500 a month. Well, then that's how we calculate it against your income. But if it's a credit card, it's 3% of what's owing is what we calculate against your income. Okay. Now, that number is 44%. There is a little bit of leeway, and there, in cases where people have excellent credit, we can go a little bit higher, okay, with some lenders. But as a rule of thumb, 39, 44 are the thresholds. 39 gross debt service ratio, 44 total debt service ratio. And when we talk gross debt service ratio, remember it's all people that are on is gross debt service ratio of all people that are on the mortgage. So you got two people on the mortgage, add up both their incomes, both their gross monthly income versus the household cost, right? So the principal and interest, P&I on the mortgage, okay? The property taxes and the heat. Now, if you are in a condo, okay, they will include usually it's 50% of the condo fees are also included.
What is the impact of down payment on your ability to get a mortgage?
The first impact of down payment would be whether or not you're going to have an insured mortgage or not. So if you're putting down 5% on your mortgage, then you're 100%. This is an insured mortgage. The insurance premium is a little over 4% at the 5% down payment. So you're going to lose most of your down payment to the insurance itself. Okay, so there's one impact. The next impact, if my ratios don't match up, can I just put down more money and bring the down payment down? And the sad truth is that that's probably not going to impact your situation that greatly. And this is what I mean. You put down an extra $10,000, the change in the mortgage amount is going to be negligible. And because of that, it's not likely going to impact your GDS or your TDS ratios sufficiently that you're going to now suddenly qualify for the mortgage. Now, if you increased your income by $10,000, well, that would make a substantial change. By just putting more money onto your mortgage, will it decrease your mortgage? 100% it will. $10,000 in income will have a much greater impact than putting $10,000 additionally on your mortgage, okay, in down payment. And we did say that this was about qualifying for a mortgage. If you have more than 20% down payment, then we could be talking about this in terms of a refinance. In order to refinance a property, you have to have 20% down. If you are refinancing a property at higher than 20% down payment, you are refinancing with a subprime lender, and therefore you're paying an additional premium. Okay, so let's wrap this up. Does a bigger down payment affect your ability to qualify for a mortgage? Most certainly it is going to. It will not have as great an impact as increasing the amount of income you have to support the mortgage, okay? So when people ask me that question, well, if I put down more down payment, what does that do? Well, it might get you out of insured financing and get you into conventional financing, and so you don't have to pay the insurance premium, and so that would be a plus. But is it going to substantively move you in terms of qualifying? Probably not, but it does make a difference if you're talking about being 39.2%. If that's your GDS and you need to get under 39, yeah, a little bit of down payment will go a long way in a situation like that.
So what would have a bigger impact, doing a bigger down payment or like paying off a portion of debt, like a credit card or something?
Very good question. Now, that depends. Okay, that depends. Now remember, we said that TDS is all the stuff in GDS plus your revolving credit. So if your TDS is above 44, but your GDS is sitting at, let's say, 36, okay, then it wouldn't make any sense to put more money on the down payment. It makes a lot more sense to pay off a piece of revolving credit. And that brings your TDS down below the 44% threshold, and boom, there you go. But if it's your GDS that is above the 39, like 39 and greater, then the only thing we can do is either reduce the amount of money being borrowed or increase the amount of income being used to support the application. And so that means if you're off by a little bit, then yeah, by all means, increased down payment would likely be the way that you would look at that. You might say, like, well, why wouldn't you get, like, if adding income is the better thing, why wouldn't I go and get a cosigner? Absolutely, and that's an option. But for many people, it's if it's a $10,000 increase to the down payment, that gets you underneath that GDS threshold, then boom, that becomes the easier option. But you're absolutely right. If the issue is TDS, then your money will be better spent reducing regular revolving credit than putting it on a down payment.
Does credit score really matter that much when getting a mortgage?
Yes and no. Like everything with mortgages, it's absolutely clear as mud.
Perfect.
Okay. So, so does credit score matter? Yes, credit score matters. When you're dealing with prime lenders, there's usually a threshold, and the threshold is essentially 680. Remember, your credit score goes up to a maximum of 900, and the threshold for prime lending is pretty much 680. Now, ideally, you want to have a much higher credit score. Absolutely. All that does is open up some lenders who have some stipulations based on credit, but it's not every lender. Across the board, 680 is your number, and it's a pass-fail. If you're over 680, we're looking at prime lenders. If you're below 680, we're beginning to look at alternate lenders or B lenders. So does it matter? Yes, it does. Once you are talking about an A lender, for example, when we're over 680, and I'm saying that, yeah, it's basically all the same. Well, it is across the board, across all lenders, and there's a lot of lenders out there. Over 680 allows us to have that that prime lending discussion. But there are some lenders that will say, not only are we going to offer you a great rate, but we're going to reduce your rate if your credit score is over 800 or over 820. Okay, so can your credit score affect your mortgage? Well, yes, it can, but beyond the threshold of 680 and being generally approved, it's not going to do you a lot of. It's not going to have that big of an impact. It's kind of a pass-fail sort of a thing. Now, when you're talking about below 680, well, now it actually matters again, because above 600, below 680, there are certain alternate lenders, what they call Alt A lenders, that will entertain that all day long. We have other lenders that will look at you if your credit rating starts with a 5. Okay. But I can also tell you this, that those, even in the Alt A space, they also have their own thresholds, and one of their main thresholds is 640. So if you're in the Alt A space, you might be thinking like, okay, well, this is like, relatively easier money to get. It is. They will charge fees up front in order for you to borrow from them. But even those lenders, like if you're below 640, many lenders won't even look at you at all. Okay. And now we're into what we would call the B space, or maybe we even have to look at what's called C lending, which would be your mortgage investment corporations and private lenders.
How many of your clients that you've worked with have a 900 credit score? How many have you seen?
I know I've seen one. I know I've seen one 900. I might have seen two. I've had lots of people that are like 850 and above, but I got to tell you, like a perfect credit score, yeah, that is few and far between. Very few people have a 900 credit score. And by the way, it's not the sort of thing where, well, if I don't owe anybody any money, therefore I have a high credit score. That is absolutely not the way this works. A credit score is a score of your credit worthiness. And if you're not borrowing anything, then there's no record of your worthiness. So the key to having credit, having a high credit score, is when you have credit, you pay it on time every single month, at least the minimum payment, and you don't have a substantial amount of your credit utilized. So you want to have utilization, you're using credit, but you are paying it down, and you got to remember, it's not paying it off. Like, so you don't go use your credit card, run home and pay it off. That'll do you no good, because every time they go to look at your credit, it's going to say that there's zero utilization. You don't know when they're going to be, tracking your credit, taking a look at it. But what you want them to see is that it actually gets used, but not to 100%. So you have a $10,000 credit card that's sitting at $9,500 worth of usage. That's very high. That's not going to bump up your credit. That's going to draw your credit down. So bottom line is if you're utilizing your credit, which is a good thing, then that's going to boost your credit up. But if you overutilize it, then it draws your credit back down. So if you're sitting at 95% utilization, so $9,500 out of 10,000, that's not necessarily a good thing. It makes it worse if you're also not paying your credit on time. But if you're paying your credit on time, that's good. We got good utilization. And as the algorithm sees you pay that credit down, and we see you sitting at a threshold of, let's say, $5,000, right? 50% utilization, then again, up goes your credit. You're showing what a strong credit user you are, so your credit worthiness.
When you pull somebody's credit during the mortgage application process, does it lower their credit score?
This is essentially an urban legend, and the legend is that if you pull your credit, it makes your credit go down, and that is such a simplistic way of looking at it and not really accurate. The purpose of you having credit is for it to be pulled by people who grant credit. So as a mortgage broker, I grant credit. Well, I don't actually grant the credit, but I help you get your credit granted. So first of all, when you get your credit pulled, that is part of the algorithm that says bring down the credit. That's true. But the algorithm is set up so that you can go and have your credit pulled. If I pull your credit, for example, I pull it once, and we don't know what it did in that moment because we don't know what your credit was the minute before I pulled it. We only know what it is when I pulled it. Okay, so essentially in this moment, it just gives us a credit number. Now, if you go to 3 other people who are providing credit around the same period of time, okay, now you're going to start drawing down on your credit. It will start impacting your credit. Absolutely. However, if you were to speak to the mortgage broker, is actually is kind of a bad example because I pull your credit once and then I speak to many different lenders. Those lenders are not pulling your credit again, and even if they do at application time, it's what's called a soft pull. This is not impacting your credit. It's basically you came to me to look for a mortgage, I pulled your credit, I extended your information to other lenders, and if they are looking at you, this is not really impacting your credit at all because, as I said, it's what's called a soft pull. Now, where does this urban legend come from? It comes from the idea that let's say somebody is not in a good credit situation. In other words, they're overutilized. And then they go out to a car dealership and they apply for a car loan and they get denied. So they go to another dealership, apply again. Okay, now we've pulled their credit twice. Okay, and that's not working either. But these people are resilient. So they go over to the brick, get their credit pulled over there too, because they might as well buy some furniture in this situation as well. What happens in this situation is the algorithm basically looks at you and says, you are a very high credit risk. You're somebody that is going out and asking for credit that you shouldn't be getting. This is where it drastically pulls down your credit, okay? The algorithm sees that you should not be getting credit, but you're trying, and now it says, nope, you try it again, and we're gonna start dropping you by like 20 points at a time. Absolutely. But going out and speaking to a broker, or even if on a weekend you were to go out and go to a car dealership and just go to a couple of different car dealerships and therefore they pulled your credit at those places, that is not going to dramatically drop your credit because those credit pulls it's like a bundle, so to speak. Like it's obvious you're looking for a car. You've got good credit, you've got good utilization, but you're trying to buy a car. Well, that's not gonna like destroy your credit. It goes down by a point. Like think about this. 1 point out of 900, okay? This is not going to greatly affect your credit. But if you're sitting at a 610 credit score, first of all, you're not qualifying for a prime mortgage anyways. But now you've gone out and you've started to look for cars while you're also trying to apply for a mortgage. That's not smart either. Okay, so yes, is your credit going to start getting dumped? Yeah, you're at 610. You're already a high risk candidate and you're trying to pull additional credit that you shouldn't be getting. Your 610 is going to turn into a 580 real quick.
Co-signers versus co-borrowers. What is the difference between co-signers and co-borrowers?
Okay. So the first difference that you need to understand in the difference between co-signers and co-borrowers is that there's no real difference. Okay.
I wasn't expecting that.
Well, the main thing, people think of a co-signer, right? All I'm doing is signing for this, versus a co-borrower. I'm on title and I'm a joint owner. Okay, and a lot of parents have done this these days, where they are co-signing. They come on board as a co-applicant with their kids to purchase a house. Okay, and when they do that, whether you're the co-signer or the co-borrower, you're taking on all the financial risk. Okay, so for example, you say, well, I'm not a co-borrower on my son's house. I only signed. I was a co-signer. Right. Okay, so let's look at what that means. It means that if your son defaults on the mortgage, you become entirely responsible for that mortgage. You don't own the house, okay, but you are 100% responsible for that mortgage. There's a thing in mortgages called joint and several. It means everybody who is touching this mortgage can be attacked by the bank to get restitution for the funds that they've loaned on that property. Okay? Yeah, I know.
That sounds incredibly intense. It's really scary.
You know what? It is intense. It is intense, and it's meant to be intense. You know, a lot of people forget that the bank doesn't want your house, but they loaned you, in some cases, $1 million or more than $1 million. They want their money back. Like, that's what they want. So when you co-sign, you're saying that you're going to take responsibility for ensuring that that money gets paid back. Okay, so let's say that's a co-signer. And by the way, this is the same thing. You co-sign for a car. When you come to me and say, oh, my car's paid off, I don't have a mortgage, I'm fine. I pull your credit and say, yeah, but you're signed onto this, Ford credit. Oh no, that's my son's F-150. Yeah, but you co-signed it. So therefore, it becomes part of your TDS, your total debt service ratio, because if he doesn't pay it, it becomes your responsibility to pay it. So therefore, we are going to look at this as credit that has been extended to you. Now, granted, sometimes we will get a lender to, kind of turn a blind eye to that because we can clearly see that it's been paid on time for a long period of time and all of the funds are coming from somebody else's bank account. Yes, that happens, but don't expect it, okay? That's all I can say about that. Now then, that's because you signed. All right, you signed on it, you're a co-signer. But in the mortgage sense, when you're a co-signer, you're not signing on as an owner strictly responsible for the debt, okay? Now, if you're a co-applicant, not only are you signing on for the debt, but you're saying that you are a part owner of the property and you will be registered as an owner of the property. Now, this does become an issue for many parents. I'm going to use parents as the example because that's usually what it is. If a parent signs on as a co-applicant and they don't specify what their percentage of ownership is, this can trigger land transfer costs, and it can also trigger capital gains issues if they are removing themselves from title down the road, or if they're removing themselves from title because the property has been sold. So consider this. You buy a property and it's you and your son have bought the property and he lives in it for 10 years. And in those 10 years, it increases in value by $250,000. Well, good for your boy, okay? And he's now gonna sell that property and move on to do something else. And we're gonna take you off title. But hold on a second. You own half of that house. And since you own half of that house, then that's gonna trigger $125,000 worth of capital gains that you're gonna have to deal with. So what many people do in this situation is mom comes on board because we need her income to qualify, but she comes on as a 1% owner of the property. Okay, and if we establish mom as a 1% owner of the property, then she is only liable for 1% of the capital gains if the property is sold. Okay, so that's the negative impact of being a co-applicant. Okay, you are part owner. Now you may want that security, and if you do, that's great. But if what you thought you were doing was signing on, then you're going to want to do it at a minimum amount of ownership of the property. But in either case, you are responsible for the loan. Okay? You are responsible for the loan as a guarantor, you're responsible for the loan as a co-applicant, and all that goes along with that. So, something to keep in mind.
Why are online calculators usually a waste of time?
Consider the amount of things that we've spoken about today. When you do an online calculation, are you including all of those things? And the reality is that the average person doesn't know the number of items that are going into their mortgage. They miscalculate because they don't include something. Oh, well, that doesn't matter. I don't own that house, so I'm not including that. For example, well, let's use that example. You signed on for your son's house, and now you're trying to qualify for a mortgage. Okay, so not only do you, but when you go onto the online calculator, you put in, well, this is how much I make. And by the way, this is another one that a lot of people will mess up with the online calculator. They go in there, how much do you make? Well, they total up the amount of money that they take home and they put that in. Well, that's the wrong number. You need your gross income, not your net income. Okay, so for starters, if you're self-employed, from earlier in this video, you saw the number of things that go into determining income for somebody who's self-employed. Did you put all that into this online calculator while you were trying to figure that out? Probably not. And then here's some of the hidden costs. So let's say you were you signed onto your son's property, as a co-applicant, years ago. It's not a problem. He pays for it every month. Not a big deal. But now here you are trying to buy a house, and you say, well, yeah. So this is my mortgage. This is what I make, and and I have barely any credit card debt. Okay, great. So you're going to get a number, and your online calculator spits back the number and says, hey, this is what you're going to qualify for. Fantastic. What your online calculator didn't ask you is it didn't ask you about your son's house. Well, hold on a second. What about your son's house? Well, there's a mortgage that's there. Oh, okay. Well, now that you're applying for your mortgage, okay, we're including the mortgage payment for your son's house. Oh, hold on. Not only that, we're also including the property tax payment for your son's house, because you're a co-applicant. You own that house, right? So we want to know, what is your cost? How are you going to afford this new house when you already have another house that you have a mortgage, taxes, and heat that have to be paid for over there? Okay, so all of that, okay, on that other house gets added on to your TDS. So now do you qualify? Oof. Okay, so that's why your online calculators can lead you down, the wrong path, unless you're an engineer. I don't know what it is with engineers. Well, I do know what it is. Engineers, they tend to be really, really smart. I mean, they're so bloody meticulous. So if you're an engineer, you're probably going to use the mortgage calculator correctly, and you will probably have a spreadsheet that has everything on it from, for the last 10 years, that includes, a pro forma for your son's house as well. So, I mean, if you're an engineer, you probably don't have to worry about this. But for everybody else, all the rest of the normal people, definitely, I wouldn't trust that online calculator. I don't think there's any engineer out there that's going to take offense to that comment.
Should you always borrow the maximum amount you're approved for?
Yes, that's how I get paid. So the more you borrow, the more I get paid. So absolutely, it's always a good idea to borrow the most amount of money that you can possibly, that the lender is willing to give you.
Take it all.
But yeah, take it all. Anything else is just crazy talk. Or you could consider the things that that are going on in your life that are going to impact your ability to pay your own mortgage. Just because you're approved today, it doesn't mean that real life won't hit you tomorrow. So if you get approved, if you're looking at your maximum mortgage amount, and and let's just say, for example, I like using car examples because most people have cars. So you've got a car, and you've had that car for like 10, 15 years, and it's on its last legs. Like, it's not lasting much longer. You don't have a car loan. But if you were to get a car loan, full well that that's going to be $500, $600, $700 a month. And so if you know that you're going to hit a $500 to $700 monthly payment, and that's not being, entered into the equation for your mortgage today, then what happens if we get you the mortgage today, you buy the house, you're living in it, everything's awesome, and then the car breaks. So now you go out and you get a car loan. But even the $500 car loan is too much for you. And you knew that, when you were getting your mortgage. You're going to put yourself in a world of hurt, in a bad situation, Or let's use something even more simple. You've done the maximum mortgage, you're not getting rid of the car. Okay, but the transmission goes, and that's going to cost a couple $1,000. Or life just hits you, and the things that are contributing factors to your life. And if you haven't, you could share it with me, and I could tell you, hey guys, you know what, you might want to think of this, but it's still not my decision. Okay, I'm going to give you advice as any mortgage professional worth their salt is going to point these things out to you. You ask the question, why should you speak to a mortgage broker? Because mortgage brokers deal in real life. Like, I don't know a mortgage broker that's not going to actually be concerned for you if they see, and by the way, we look at your financials, and I can paint a picture of my clients just by looking at their credit rating and their credit bureau, and knowing what their incomes and their liabilities are. We really do get a pretty good picture of what's going on in your life. And so, yeah, if I saw that and I saw, hey guys, have you considered this? That's my job, is to definitely make sure that I point those things out. Is there something that could be coming down the pike that could actually impact your ability to pay your mortgage? Of course I'm going to say something. But at the end of the day, it's still going to be your decision. And so when you're making that decision, should you get the maximum mortgage amount, just consider your life and what could possibly go wrong. And if you've done that and you feel comfortable with your maximum mortgage, then by all means, buy the house, take the bigger lot. But if, you're thinking to yourself, if anything goes wrong, that's a lot. Well, then maybe our ratios, aren't the best metric for you, and you should do the math on your own month and figure out whether or not you should take on that additional debt. Ultimately, decision is yours.
And a mortgage calculator won't take that into consideration for you.
No, mortgage calculator is definitely not going to ask you those questions.
We still hate them.
Yeah, we still hate them. Maybe
Don't use them.
If a mortgage calculator was applied to like AI, you're going to type into it that, yeah, we want this, and I've got this car. The day a mortgage calculator turns back to you and says, Dave, do you really think the car is going to last that long? When we have mortgage calculators that can do that, then definitely mortgage calculator all day long. But until then, I'm going to say, talk to a mortgage broker.
Well, that's all I got for you today, Mr. Walters.
And for today, that is the bottom line on mortgages. And can I ask you please to like our video, especially if you watched it this far, and subscribe. We are going to continue to put out videos that discuss the different aspects of mortgages, mortgage intelligence, the things that you need to know. We greatly appreciate it. Thank you.